Welcome to Behind the Ticker. I'm Brad Roth, Chief Investment Officer of Thor Financial Technologies and Portfolio Manager of THLV, the Thor Low Volatility ETF. Behind the Ticker uncovers the inner workings of the ETF industry. We will interview portfolio managers and ETF service providers to dive deep into their work lives and their businesses. We will learn the inner workings of their strategies and what drives them as they continue to grow their company. Many of these individuals are entrepreneurs and will have unique and compelling insights to share as much goes on behind the ticker. Please note, nothing in this show is investment advice, and it is meant solely for educational and entertainment purposes only. Welcome to Behind the Ticker. Today we have on Andrew Skatoff. He is from Bancreek, and we are talking about their two ETFs, BCUS, which is their US large cap ETF, and BCIL, which is their international large cap ETF. It's a very interesting episode as Andrew has come out of the family office space and has built a quantitative model that uses both fundamental as well as other quantitative factors to identify what they deem structurally advantageous companies to put inside of their portfolios, both in the US large cap space and international large cap space. They rely solely and fully on their models, so it is completely computer driven. So I think you'll find this episode rather interesting. So without further ado, please welcome Mr. Andrew Skatoff. Hey, Andrew, welcome to the show.
Hi, Brad. Thanks for having me.
So before we get started, why don't you share a bit about your background and how you eventually started Bancreek?
Sure. Well, it all started after graduating from business school. I went to Columbia Business School and went through the value investing program and graduated in 2009, right after the financial crisis. As you can imagine, it was a very interesting time to be looking out into the marketplace. And I was very fortunate because I ended up finding my way into the family office world and joined this wonderful New York-based family in 2009 and really learned the framework and mindset needed to compound capital over long periods of time. Both our CIO and the family just had this wonderful framework on how to think long-term when investing. And, I spent the next decade plus kind of looking at direct public equity opportunities and direct private equity opportunities for the family, and really spent a lot of time thinking through, the right kind of qualities or attributes that you would want for businesses to invest in that can help you compound your capital over generations, and ended up kind of creating this strategy around the public markets. Given that there was so much data out there, you could really dig in and find these types of wonderful businesses. And so kind of created this portfolio of what I would call structurally advantaged business models for the family, and ran it internally for a number of years before ultimately spinning out in early 21 to work with other family offices that I thought would be interested in kind of what we were building internally. And then, we've been running kind of this capital for families the last few years, and the overall strategy has a very, what I would call data centric bent to it. And ultimately, we figured out a way that we could bring kind of this pure quant version of our strategy to the marketplace through the ETF wrapper. And we launched our first ETF, which is our US only BCUS, last December. And we launched our international only, excluding US, ETF BCIL in March of this year.
So can you talk about the decision to, you have a great family office job, to make that jump to start your own company and really take on, that entrepreneurship role? Like, was that a hard decision? Did it just feel right to you?
Yeah, it was an incredibly difficult decision. I think mainly because I enjoyed working with the family and our CIO so much. I mean, I was learning so much, having these wonderful opportunities. But at the same time, when I started to come up with the strategy, and we can talk about kind of the data focus around it, and it's all predicated around information theory. I realized that what I was coming up with was so interesting that I needed to dedicate all of my time to really see it through and dive in and I think create the expression that we have today through the ETF. So it wasn't an easy decision, but it was something that I felt was super interesting, and I needed to dedicate all my time to kind of build it out.
Yeah, no, that's great. Before we get into kind of Bancreek and the strategies, the ETFs, and kind of the data set that you're using to kind of build these portfolios, I always like to ask people, what do you like to do when you're not working? I know as an entrepreneur, it's going to eat up a lot of your life, but do you have any hobbies when you're not sitting behind the desk?
I do. So I have two young children, a 10-year-old boy and an 8-year-old girl. I spend a lot of time with them playing sports. So I've coached both my son and daughter's basketball teams. Um, you know, as a parent, you typically are traveling quite a bit on the weekends, kind of chauffeuring them around to different events, whether it's gymnastics or basketball or tennis. So I spend a lot of time with them. I also like to get out and run when I can. Based in California, the weather is pretty great. So I do tend to get out and run as often as I can. And then, spend time with my wife. We'll go out, to dinners or just, walk around the neighborhood. So I do try to stay active when I'm not thinking about investing in data.
Yeah. Well, I've tried the running thing. I'm not much of a runner. I try to get my exercise in some other way. I think I just have heavy feet. But good for you for getting out there and getting after it. But let's talk about Bancreek. I know you have two ETFs out there. So are you providing, other things to clients such as research or SMAs or indexes? Like how else are you working with clients outside of the two ETFs?
Sure. So once we made the decision to kind of create the ETF platform, we launched our advisor site as well. And one of the things that we had been doing internally for a long time was kind of developing and looking at data visualization tools, primarily through a software program called Tableau. And one of our partners on the investment team, prior to joining Bancreek, had spent a lot of time kind of building out and providing transparency for the drug pricing industry. And so this was something that was interesting to us. And, we spent a lot of time kind of building out these tools. Our first tool that we published was around inflation, CPI, and PCE. We recently put out a new tool around employment. And we decided to just publish these tools free for the public. And it's on our website, bancreek.com, so that everybody can kind of explore the tools. We've even been pretty fortunate to have some of our data tools published in the Financial Times and the Boston Globe. So the tools I'm hoping are providing some additional value to folks out there. So outside of investing, that's kind of one of the other things that we've been providing to clients and non-clients, really just anybody that's interested in it.
Yeah, well, the mantra at the firm seems to be driven all around data. So I guess what kind of data are you taking in? And obviously, more importantly, how are you using it to drive investment decisions?
Sure. So if we kind of look back to my days with the family office, when I was kind of creating the initial strategy, what I was doing was creating a checklist of what I would call fundamental and quantitative factors for assets, right? And so things that I thought led to long-term compounding. And again, this was the initial checklist, more of a crude version of this. And as I was doing more and more of this, I realized that I needed a lot of help to make it more efficient and to broaden out the scope of the data that we could look at. And that led to me leaving, but also bringing in our chief data scientist, Anon Yen, who spent almost 2 decades working at Lawrence Livermore National Labs and Lincoln Lab, and really specializing in modeling and simulation of complex data systems. So really what we wanted to do was bring in as much data as possible. And again, it's for the investment world, it's really focused on fundamentals, so things that the company is releasing and reporting, and then quantitative. So we've developed a number of features over the years that we believe help identify these structurally advantaged business models. And it's all focused on that. It's taking the data and using it to identify businesses that have an edge, right? And so the edge in a business could be something like brand development over 50 years, or a robust distribution pipeline, or a company that has developed these meaningful network effects. And we feel like we have figured out a way to take this data to help us look and recognize specific patterns that are highly correlated with identifying these business models.
Yeah, can we dive into this term structurally advantageous like a little bit more? You gave some examples there, but
Yeah.
when you're finding, a company or an avenue that you get really excited about, how would you kind of define the word structurally advantageous, and what types of companies or, as part of your data checklist are you checking off to make sure that you've, identified one that you're excited about and you're ready to invest in?
Yeah. So, again, over the years, the tool that and the engine that we've kind of developed is purely quantitative now. So, we're very comfortable that when the tool is identifying a business, at this point, we know there's something unique about it. And when you think about an edge, obviously a lot of people use terms like moats and the quality businesses. Really, you're looking for companies that are very efficient in their own capital allocation decisions, right? So they have this edge where they can either get pricing or they're uniquely positioned where they're really the only game in town, or there is a long run rate for growth, and they can either deploy the capital to grow internally, or they can make accretive acquisitions, right? So it runs the spectrum of you obviously need the growth to compound, and it can either come internally or through external acquisitions. So when you're looking for a company that has that edge, you're looking for all of these things to kind of come together. And typically the companies that we're looking for have been around for a very long time, right? So if you're looking at a company that's been around for 100 plus years, clearly there has been something that has made it hard to disrupt. And again, we talk about edge and compounding. You can compound that edge over time. So every year that a company is in business, they're able to strengthen their positioning. So really, when we're looking for the data, the quantitative data, you're looking for assets that are fairly predictable for management, right? So if management is management team has this business and they have these assets, what you want to be able to do is be able to predict, like, hey, this is growth expectations for the next year, or whatever visibility duration you have, and the best businesses, or the best, what I would say, like long-term compounding businesses, have a fairly predictable, at least shorter-term future. So it basically, you have fewer surprises for management and then ultimately investors. And so what that leads to is what I would call like a less volatile path to growth, if that makes sense.
Yeah, no, it makes a ton of sense. I think one of the differentiations, if I'm picking this up, is that like most quantitative systems that are built, they're kind of focused on shorter and medium term opportunities, right? They're trying to build edge around, momentum or certain inefficiencies that might be taking place in the market. This, to me, the system that you've built seems to be trying to really mine for and find long-term value. Would that assumption be kind of correct?
Exactly. So we're basically applying quant to long-term investing. And again, I think that is kind of the unique proposition that we're offering, that we've figured out, a way to really pulse for specific patterns in these assets over long periods of time, looking at a ton of data. And again, there's been, it's pretty highly correlated that when we find these specific patterns, that once you dig into the business, it's typically like a terrific business that's been around for a long time.
So let's talk about BCUS, which is your US large cap ETF.
Sure.
At a very high level, can you just kind of talk about what the fund is trying to achieve and accomplish?
Yep. So, with these tools that we've developed, what we do and what the engine does is rank every company in the investable universe that we're looking at. So for BCUS, it's large cap US companies. So we're ranking every company, let's call it roughly 5 billion or more in our investable universe, based on the factors that we talked about, some fundamental and then some quantitative that we've developed internally. And we're ranking them. And then the model will tell us, here are the top 30 or so businesses, right now, according to kind of our data. And that's what will be expressed in the ETF. And so we're looking to create this basket of structurally advantaged business models for our shareholders.
So my next question was going to be, what's the investable universe? So I've got that down. I've kind of two questions off of that, just out of curiosity. Have you looked at trying to apply this to maybe the mid cap space? Have you had any success finding an edge there?
We have. We're constantly looking at, other markets that we can apply this to. Mid cap for sure is on our radar, and we have been looking at it. Honestly, the focus initially has just been to get the large cap space covered, because obviously it's a really large market. We think there's a lot of opportunity in the US and really in the international. So our focus has been primarily on those two, but we have started to look at other markets. And again, the nice thing about the framework that we've developed over the years is you can apply it to a number of different markets. So it's not unique for just, the US large cap or international large cap. We feel like we'll ultimately be able to apply it across a number of different universes over time.
Yeah, no, that's great. And one more thing about kind of looking at US large cap like that, it's a big universe. It's obviously a big marketplace. Do you ever start to see kind of flows and trends inside of your screens as you're ranking companies that might tilt a little bit more towards value, or sometimes could potentially tilt more towards growth? Or are you primarily just seeing value in the portfolio? Can you talk about that at all?
Sure. I would say, we're kind of in that sweet spot of you want like the quality businesses that grow, right? That's ultimately what we're searching for. So, if all of a sudden a stock gets hammered and is trading at like 10 times earnings, for us, that, our tool is probably not going to love that, because there's probably something going on within that business for that asset to trade off to that extent. We're really looking for the companies that, let's say, have this historical growth engine. And when I say historical growth engine, it's actually a metric that we've kind of created internally, where we're looking at a number of rolling periods over time for a company to determine like, hey, this has been its structural growth rate over X number of years. And so we're looking for the companies that tend to have like low to mid teens kind of growth that they've been able to achieve over long periods of time. And so given that, we also are looking for stability in that growth. So, I think what you see, in terms of trends over time is you might see some trends in terms of overall sector exposure. Mm-hmm. So, right now, if you looked at BCUS, you would notice that we have a large exposure to industrials right now. I think if you follow this back over decades, you probably do see some shift in sector exposure. But ultimately, we are looking for what the data is saying and telling us to be like the top, companies with edge at any given point in time.
So kind of piggybacking off of that sector exposure, do you allow the screen to kind of take you anywhere in terms of that sector or industry exposure? Or do you have any kind of guardrails to say, hey, look, we only want to have a max of, I'm making this up, 50% exposure
Sure.
in consumer discretionary or in industrials or whatever it may be? Or do you kind of just let it run?
Yeah. I mean, honestly, we kind of let the tool run. Again, we've spent years kind of developing this. And so we're really comfortable with the businesses that it is identifying. Sometimes they're just going to have a higher exposure to certain sectors. Industrials is kind of interesting because it's almost like a hodgepodge of businesses. It's, if you think about industrials, it's like every company that doesn't have like a clearly defined sector kind of gets lumped into industrials. So if you look at ours in particular, like there isn't a ton of overlap, which again, just gives us more comfort that, it's okay to have, some level of concentration across sectors. So I would say what we found to yield the best results is to kind of let the tool do what it does and kind of, follow, the allocation recommendations that it has.
So you've run your screen, you've got your 30 or so names. How then are you kind of making decisions around weighting and doing portfolio weighting around those names?
Yep. So that's all determined by our engine. We refresh the portfolio monthly. So there could be changes to, the constituents within the ETF on a monthly basis. But again, we're relying on all of, the longer term data to help us kind of stack rank all of these businesses. But the ETFs are totally reliant on the tool that we've developed in terms of construction of the portfolio and sizing and everything.
Right. Yeah. And does it end up being, I'm sure you get, a tier down in weights, but does it end up being fairly, I don't want to use the word equal weighted, but are there any massive divergence in terms of significant exposure at those rebalances, like one name getting 40% of the portfolio or 30% of the portfolio? Or is it fairly handed out between all 30 constituents?
Yeah, I mean, I would say for the most part, it's going to be fairly equal weight, because that's the approach that has yielded the most interesting results through our research process. Having significantly outsized positions, while great when it works, leads to enhanced volatility, and so that's not something that we're going to have in the portfolio. So I would when you think about Bancreek and our ETFs, think about the position sizes being in the 3-ish to 4-ish range, and that's you could have some things that are working well that get a little bit larger or a little smaller, but that's kind of the range that I would expect to see in the ETFs. I certainly wouldn't expect a 10% position or anything like that.
Got it. And so you had mentioned you're rerunning the screen and kind of rerunning the weights on a monthly basis. Yeah. Anything intra-month, or just let everything run for the month?
Yeah. So, I mean, we're constantly working on the engine. So that's kind of where we spend a decent amount of our time. So we're constantly testing, trying to find new features, things that could improve the portfolio's performance. But the cadence of the ETF right now is for a refresh every month, even though we're constantly working on it in the background.
Got it. So looking at BCUS, you're sitting down with an advisor. He's got, he's got large cap exposure in a diversified model portfolio. Where are you kind of advising or recommending this advisor kind of allocate to BCUS, and like, where would you put it?
Yeah, I mean, certainly kind of in that large cap bucket, almost straddling kind of like the growth and value plays. We kind of think of ourselves as a more efficient version of the market, right? And so we certainly could be pretty flexible in terms of where we're placed in any portfolio.
So let's make a switch. Let's pivot. Let's go over to BCIL, which is your international large cap ETF. I'm going to make an assumption that it's a very similar fund to BCUS, but it's just using an international universe. Is that correct?
Yes. So the framework is exactly the same, right? We're collecting all of this data that's available to us, and we're using our tools to determine, what's the right model or weightings for all of the features that we develop for the international markets as opposed to the U.S. markets. But same sort of framework involved, looking for, let's call it 30 or so terrific, structurally advantaged businesses internationally. And, I feel like the international markets kind of they get a bad rap, and have for, the last decade plus, really because, the U.S. markets have outperformed significantly, right, as a whole. But when you actually start digging in, the top echelon of companies internationally are right up there with, the folks in the U.S. markets in terms of performance and overall quality of their business models. So we're actually really excited about BCIL and think there's a lot of opportunity. And really, there's not a ton of products out there in the ETF marketplace to address these wonderful businesses and give investors the opportunity to invest in them.
So I would assume, again, I keep making assumptions on you, that most of the international exposure, given the type of screen that you're running, are coming out of those international developed type markets. Are there any kind of country restrictions? Are you not looking at emerging markets at all? So would that be correct?
Yeah, so we're in the 22 developed economies. So, there's 23. We're not in the US, but we're in everywhere else. So Canada, Western Europe, Japan, New Zealand, Australia, those markets would be the markets that we're focused on. We wouldn't have exposure to markets such as China or India or Brazil at this point.
So just thinking about like the international marketplace as a whole, do you think that there are certain situations, or because of a certain company or country, rules or laws that might make some international companies, in some cases, giving you an opportunity to find even more structurally advantageous opportunities?
Oh, for sure. I mean, that's the exciting part, right? So there are certain markets where, just being in that market from a geography perspective is a strategic advantage. And so you'll see that for sure, where, they might have, 25, 30, 40% market share in that country just because, that's where they're based. And that's the advantage that maybe the government has put in place for them, or or just because there's the language barrier, whatever the case may be. These companies have developed this advantage, no different than kind of the U.S. companies that have developed their advantage domestically. You see the same thing internationally. I would say that for the majority of the case, though, it's these international companies, just because they're based in, let's say like Sweden, they're still global companies. They're still selling through, to the U.S. and almost every developed market too. So, you look at that and it's like, okay, they're not that dissimilar from the types of companies that we're finding in BCUS.
So, I mean, you touched on it for briefly, but we're not making any predictions here or recommendations, but like, given the disparity between how international markets have performed and how the US has performed, and how many standard deviations away from like the historical norm in terms of, the performance upkeep, do you think it's time for advisors to start thinking about international exposure to them? Because it's been a really tough go. A lot of them don't want to invest in it at all. I'm on the camp that now's probably the time to start looking international. Would you kind of agree with that sentiment?
Yeah, I mean, we love our BCIL ETF. Like, we think that's a really interesting place to look for these types of businesses. And again, you're right. They haven't received the attention that their U.S. counterparts have for a number of years, but they're still there. They're still growing. They still have their own moats and strategic and competitive advantages, and they continue to compound those edges over time. And if you're looking for the right types of businesses and assets that can generate and grow at low to mid teens over a long period of time, regardless of the multiple, and you could argue that the multiples have compressed internationally, I think you end up with pretty interesting returns long term if you're able to handle some level of volatility in these markets.
Yeah, no, I would agree with that. So both of your ETFs are rather new. You guys are, an entrepreneur driven, small business. Kind of two questions. Like, really, what was the decision, and how hard was the decision to kind of jump into the ETF space? There's a lot of funds, there's a lot of competition. And how are you thinking about, growing and marketing your funds over the next, 18 and 24 months?
Sure. So the main decision to make that jump into the ETF marketplace was really the fact that what we're doing is unique and is not something that we saw in the marketplace. So, we also saw a marketplace that was growing, especially actively managed ETFs. So we looked at that as a compelling opportunity, just given that there's so much growth going on in the space. We thought we were bringing a unique concept to the marketplace. And we found really good partners in Exchange Traded Concepts who are our partner for our platform, right? So we work with ETC to kind of launch. We work with ETC to launch BCUS and BCIL, and so that was kind of the decision process. How we're kind of going to market is we're talking to RIAs to kind of help them with their own portfolio management, so they can, potentially have access to the companies in BCUS and BCIL for their clients. And it's really just kind of going to some conferences and talking to folks and just trying to get our name out there, so folks at least take a look and see kind of what the holdings are, because we do think we're pretty unique and differentiated from most of the ETFs out there in terms of the constituents within our ETFs. And so that's kind of what we've been doing to just kind of talk to folks and get out there and hopefully have people take a look at us.
Well, speaking about taking a look, where can people learn more about you, the company, and find information on BCUS and BCIL?
Sure. So if they want to start just learning a little bit more about Bancreek in general, they can go to our advisor site, bancreek.com. You can learn a little bit more about our history. You can play with some of the data visualization tools that I mentioned earlier. And if you want to learn more about our ETFs, you can go to bancreeketfs.com and learn more about BCUS, BCIL. You can see the holdings that we have, and read a little bit more about our process online.
Well, Andrew, thank you so much for spending some time with us. I hope to see you out on the conference circuit, I'm sure. But again, thanks for spending some time and appreciate you being with us.
Really appreciate it, Brad. Thank you so much.